After Donald Trump's demonstrative punishment of Colombia, concerns about a broader global trade conflict have resurfaced. Initially, Bogotá refused to accept plans from the US deporting illegal migrants. However, under the threat of 25% or even 50% tariffs, the Colombian government agreed to all the terms set by the American side. As a result, market sentiment remains risk-averse. Unfortunately, news from Beijing ahead of the Lunar New Year celebrations does little to lift optimism. Today's reports on the business activity confirmed the weakness of the Chinese economy. Both manufacturing and services PMI sank by about 2 points each. Besides, the manufacturing PMI not only posted its sharpest contraction in 5 months, but also fell below the critical 50-point threshold, landing at 59.1. This week, the central banks of the US and the Eurozone will hold their policy meetings. The policy decisions are generally anticipated and partly priced into the values of the dollar and the euro. Still, most traders are likely to refrain from making sharp moves for now. For example, the US dollar index, which tracks the greenback's value against 6 major currencies, traded within a narrow range of 107.40 to 107.80 on early Monday. Analysts suggest that on a Thursday, the European Central Bank will once again cut its key interest rate by 0.25%. At the same time, the economic growth gap between the United States and Europe appears to be narrowing. Reports show that Germany's business climate is improving, with its index rising to 85.1 in January. Additionally, Donald Trump isn't in no hurry to impose trade tariffs against the Eurozone. Isn't it a solid reason for the main dollar's counterpart to strengthen? After all, last week the euro gained more than 2% against the dollar and closed Friday's trading in a positive territory. Of course, given the factors shaping the mood at the start of this week, it would be overly optimistic to talk about the sustained bullish momentum for the euro. However, correction in the euro-dollar pair is already underway. The only question is how sustainable this trend will be. During the correction, the price tested the support area at 1.0480 and attempted to consolidate toward the critical psychological level of 1.0500. For now, with the dollar's growth stalling, the currency pair has a chance to rebound. The anticipated pause by the Fed Reserve on January 29 and the ECB's rate cut on January 30 are likely to limit this rebound. Until then, the euro-dollar pair will most likely remain within the range of 1.0400 and 1.0500. Last week, oil prices, on the contrary, declined for the first time since the beginning of the year. Brent crude dropped by 2.8%, while WTI fell by a more substantial 3.5%. The main factor behind the pressure was Washington's decision to boost domestic oil production. Another catalyst for the decline was Donald Trump's calls for OPEC countries and Saudi Arabia to lower oil prices. Whether influenced by the United States or not, OPEC and its allies also announced plans to pump up oil output starting from April this year. Importantly, the US president has plans for the European Union as well, which will be expected to purchase more American oil and LNG. As for the consequences of these variants, the United States has already demonstrated its stance using Colombia as an example. Meanwhile, according to analysts at Goldman Sachs, higher freight costs and a cheaper Russian oil are supporting trade. Interestingly, the severe US sanctions against Russia's oil industry have had a little impact on the production so far. As a result, although Brent traded below $80 per barrel today, it maintains an upward momentum inside the daily range of $76.5 to $77.90 per barrel. Thus, Donald Trump's plans are unlikely to impact the oil market in the short term. oil remains a tool for the long-term geopolitical maneuvering, where key players act with a great caution. As for the Russian currency, it opened the week on a stable footing. The ruble is supported not only by still high oil prices, but also by the central bank of Russia's firm stance. Additionally, the national currency may receive local support at the peak of the tax period. As a result, the calculated exchange rate of the ruble has returned to early December lows, around 97.13 rubles per dollar. On the other hand, the ruble could face pressure from seasonally low demand for foreign currency, falling energy prices, and of course, geopolitical news. Experts say that the dollar-ruble pair could trade between 99 and 101 over the next few days. So that's all for today. We continue to follow developments in the financial markets. Subscribe to our channel and follow news with us. See you soon.